Welcome back to the Crypto Academy channel, where we talk about market psychology, trading skills, and a whole range of different topics surrounding cryptocurrency, news, and TA. We're here with Wolves of Crypto today. We're going to be talking about the death cross. We're going to talk about can anyone succeed in trading and why 80% of traders fail. Without further ado, Wolf, I'll hand it over to you if you want to show us what we talked about last week and maybe jump in and we'll get started.
Sure thing. All right, so this is the second episode, of course. Last week, we did have a discussion regarding a few topics, namely one on DCA, namely traders versus investors, what it means to be a trader, what it means to be an investor, what are the differences between the two things, and of course, what is the objectively better one, more profitable one to be. And we also talked about the Amazon fractal. But today, entirely new topics. That video is still relevant. Check it out. The death cross. That is the first topic of this video. And what is the death cross first and foremost? Well, I'll show you right now, right? There's no such thing as the death cross, but this is a death cross that is playing out in a very important chart, which is the weekly chart. The death cross, a death cross, is when the 50 SMA crosses below the 200 SMA, right? The 50 SMA in this case is the red line and the 200 SMA is the green line. You can see that historically we have never seen the red line cross under the green line on this weekly chart. We got very close to it here in 2015. It didn't quite happen. 2018, we didn't get very close. They did converge, but they ended up going away from each other in the end because we saw a massive spike in price action towards the end and towards the start of 2019. Right now, they're moving very rapidly towards each other, and there is an argument to be made that we could be seeing that death cross as soon as mid to late January. I want to get your thoughts on this, okay? Because death crosses, just so you guys, if you don't know, are basically a bearish technical indicator. When you see a death cross, generally speaking, it does lead to a crash. And when you see a golden cross, which is the reverse, it does lead to a pump. What do you think about this just off the bat?
Yeah, so personally, I don't really apply too much significance to death crosses. And it comes back to, I guess, the nature of what a moving average is. And the reason why I don't apply too much significance into it, because moving averages are diagnostic indicators, meaning they're telling you a story. They're telling you a story of the trend. And generally, when we see converging between smaller time frame and larger time frame moving averages, all that's already telling us is there's a phase of consolidation or decreasing volatility in price action within that period of time. So if you go ahead and bring up the death cross again, actually, Wolf, and you can see on the chart over here, nearing the end, you'll see how the 50 EMA is starting to aggressively turn towards the downside, closing in on the 200 SMA. And what is that really indicating? Well, it's indicating two things. Overall volatility is starting to speed up on a smaller time frame, hence the 50 SMA is basically nosediving to a point. It's significantly come down tighter. And the gap between the 200 and the 50 represents the consolidation. So there is a phase of compression and consolidation in the price action over a smaller time frame, and that's indicated by the death cross. We see the 50 come closer and closer towards the 200, which is representing compression, consolidation in the average price. So when I look at the death cross, I'm not necessarily saying, okay, this is going to be a trigger for a continuation downwards. I'm not necessarily looking at it as a indicator to base an analysis off, to base particularly my decisions off, but it's more or less a descriptive indicator on what the trend is doing. Mm-hmm. And yeah, you can use those descriptive indicators to assess the market, make decisions, but more or less when it comes to these larger time frame indicators, such as the weekly, 50, 200 death cross, I wouldn't be necessarily saying, okay, we're crossing over here. If we cross over, we're going to like a 4-year bear market. I think it's very much lagging, and it's just expressing a lot of consolidation that's occurring. And that is why on the prior two cycles, as we see the bottom become closer and closer, we naturally see the 50 SMA come closer to the 200 SMA because there is a degree of consolidation and compression that occurs nearing the bottom of these cycles. What do you think, Wolf? Give me your opinion, man.
Well, look, here's the thing, with diminishing returns on Bitcoin, eventually these things and we've seen multiple things that haven't happened before that were supposedly going to be massive, massive things happen. For example, even just looking at this chart here and removing our view of the 50, we have the 200-week SMA, right? This is something that held for support on the weekly chart for the entire price history of Bitcoin since 2015. It held in 2015, 2016, held in 2018, held in 2020 for the most part, and we lost it. We lost it here at the middle of 2022. that's something that people said would change the entire macro structure of Bitcoin, something that's never happened before has happened. Well, guess what? It wasn't that surprising, because if you actually take a deeper look and you look at the percentage returns down to the 200-week SMA, we saw an 80% drop in that first cycle there in 2014. We saw, again, an 80% drop in 2018. But due to diminishing returns, that 200-week SMA was dramatically closer to the top than it was in those cycles. And so, yeah, we saw something we've never seen before, but it was only during a 60% drop, which is very typical of a bear market. You actually go lower than that. So I think just because something, you covered the points pretty well, but I will just add this. Just because something has never happened before, it doesn't mean it's automatically a scary thing that everyone should be petrified of. It can very well happen, and it could even lead to a drop, and we could very well still recover healthily, right? But another thing I want to just talk about as well is that what you'll notice is that what we generally see is these lines get very close to each other, and then we see a pump and they do get avoided. So there is a chance that it might not even happen at this point. We could actually go up fast enough to avoid it entirely. But yeah, overall, I do understand the concern. If you're looking at the 3-day chart, for example, def crosses on the 3-day chart particularly have been very scary for Bitcoin. You're just looking here at 2014, we saw a def cross. We immediately saw a massive correction. Same thing in 2018. In fact, 2018 was pinpoint precision. That def cross happened on the day the correction started there. And 2022 is the same story. So I understand the fear around it, but I don't think it's something that's worth getting too worked up about. And I suppose that's my opinion on the matter.
Yeah, and if you go back to was it the daily you were just on, or a 3-day chart?
3-day chart, yeah.
Yeah, so if you go back to a 3-day chart, look at the price action and then look at the moving averages. So this just goes back to what I was saying before, how moving averages are descriptive analytical tools, because you can see how in the 2018 point, we had that aggressive breakdown of that consolidation phase on the 2018 point at the moment of the def cross. So this is where people get confused. It wasn't because we had a def cross that the price crashed. It was because we broke out of an extended consolidation phase and the volatility spiked to the point of which the average price over a 50 SMA period become lower than the average price over a 200-day period. So people get confused and they think, okay, a def cross is happening and it crossed over and therefore we're going down. It's more or less the other way around. The price is consolidated for an extended period of time, therefore the moving averages are compressing, and then if the price breaks downwards or upwards out of these consolidation patterns, the price will then be volatile and the moving average will either have that cross or that rebound like we see at the bottom. So I think it's one of those things people get a little bit of misconception on. Moving averages are quite interesting analytical tools because they do more or less show the strength of the trend. I think a lot of people get mistaken when they're using technical indicators. Technical indicators, in essence, are used to gauge the overall trend strength. They're not designed to pinpoint reversal points. They're not designed to pinpoint breakouts or continuations. They're designed to help you analyze and understand the strength of the trend. And the strength of a trend can obviously assist you in finding potential reversal points, such as a 50 SMA cross on a 2-day chart after the price has made some sort of rounded bottom or consolidation phase, and then it has a break of a bullish structure plus a 50 SMA cross. Then you have a bullish breakout of a structure which has been consolidating for X amount of periods of time, plus the price is over the average 50 SMA price for a specific time frame. So then you have a bullish break, plus you have bullish momentum, plus you have bullish trend, and those confirmation points can equal the trend continuing upwards. So I think a lot of people get confused in, when they should use technical indicators, how they should use them, and more importantly, what they're actually telling you. And I think before you can actually use an indicator effectively, you really need to understand exactly what they're telling you. And more importantly, you need to understand the limitations of those indicators. More importantly, what they're not telling you.
Yeah, and just as you were talking there as well, by the way, I completely agree. Just as you were talking there, I kind of did bring up a few patterns here just to show you that this drop maybe wasn't triggered by the def cross. It was just naturally going to happen as well. You have to remember all these things are connected. The only reason these moving averages get in those positions in the first place is due to other market patterns and due to the price action itself and the shape of the price action. So yeah, we saw a def cross, and yes, that happened maybe by coincidence, maybe not, on the same day as the drop, but ultimately we were in what looked like a descending triangle formation there. That drop was probably coming as per the 4-year cycle as well. We were in the peak bear market. And the same thing in 2022. Yeah, def cross happened again. Guess what? Happened around the same time as the drop, but we were in an ascending channel formation. That was actually a bear flag formation there. So again, it probably would have happened regardless whether or not we actually saw the cross it's it's something that's up for speculation there. So yeah, I suppose that's a good way to end off that topic there. Lots of questions about that in my community. I'm sure you probably had the same. And we can just dive in straight into a different topic then. And speaking on the topic of bear markets and losing money, I suppose, because that's generally what happens to people in a bear market. I suppose it kind of brings out the difference between someone who just got lucky in the bull market and someone who's actually a good trader. Because, believe it or not, and you guys probably have to believe this, it's just factual. During the bull market, you could buy 9 out of 10 coins are going to go up, right? Anything you buy realistically is going to go up unless you buy micro cap and get scammed. And basically everything's going up during the bull market. So if you made money during the bull market, unfortunately, you're not a confirmed genius. I hate to break it to you. If you make money during a bear market, however, you're probably a pretty good trader. And so that begs the question that I'm going to pitch to you here. Can anyone become a trader? Is it something anyone can do? Are there people who maybe it's biological, maybe it's social, maybe it's skill level? What is it that makes a good trader, and can anyone be that? What do you think about that?
Yeah, so look, this is a really interesting question. I love questions like this, but particularly for this one, there's so many different avenues, I guess, or paths that you could kind of answer this question from. And I think we can start from like a psychological basis, maybe a social basis, and then move into more of like a skill set and like application basis too. So from like a psychological basis, this is what I think. I thought about this a lot, and I definitely do believe anyone can succeed when trading. But I do believe some people are genetically or socially wired to have significant advantages over some people or shortcomings over some people. So I believe everyone can get to a point where they're a proficient, successful trader, but I believe everyone starts at a different position. For example, right, your upbringing can play a big role in your habits, particularly your impulse control. If you come from a broken family, if you come from a family that's maybe, we'll go a bit extreme here, maybe abusive, okay? Maybe even single parent households, and it gets pretty in depth there. There's a lot of studies to show you guys that, single parent households, children are more impulsive. They're more risk taking. They have less impulse control. And that's kind of like a negative habit or a barrier that can translate into your trading that could be detrimental to your profits or success as a trader. Impulse control is a big one. We already know that impulse control with poor impulse control, you're probably going to FOMO in. You're probably going to panic in your trades. You're going to jump in and out of trades too quickly. You're not going to give it time to develop. You're going to make quick decisions. And that's one barrier. So your social upbringing can definitely either shape or and create a personality or whatever you want to say, environment in yourself that will either facilitate correct or proper behavioral strategies when trading, or again, detrimental strategies when trading. What do you think about the Wolf? Do you think your behavior and like your upbringing as an individual can definitely shape? Like, I can speak of my experience, but I do think your upbringing as an individual can shape whether or not you have a genetic or social predisposition to becoming a better trader. Like from a base standpoint, like you're a brand new trader, you got two people, brand new traders. Do you think that their social upbringing, their genetics have a role in influencing how good they are from the get-go, like from the same level?
Oh, 100%. 100% think that. Even in my personal life, and you could probably attest to this as well, I know people who I can look at them and I can think, okay, you probably need some work if you're going to do this. And then I know people, I can look at them and they have a very, methodical mindset, very evidence-based, who aren't overly emotional. And I think, okay, you'd probably make a good trader if you put the effort in to learn. Both of which are still going to have to learn TA, but one of which is going to have to work a hell of a lot harder to try and change a fundamental part of their personality and trying to control their emotions to a different extent in order to succeed. Now, on that topic of upbringing, the interesting thing that I was thinking about just while you were talking, just off the top of my head, is you think about the last 20 years, rise of the internet, rise of social media, you think about the depreciation in the attention span of people, particularly. We've seen, and I just Googled it during when we were speaking there, in the last 20 years, in 2000, the average attention span was 12 seconds. Now it's just 8.25 seconds. I think it's interesting because during the rise of the internet, we see a rise of entrepreneurship, right? We see a rise of people at reaching out and marketing to people, hey, become a trader, it's a good way to make money. But at the same time, we see a rise in impatience. So it's kind of a deadly combination. And I would go as far to say that, and I don't have evidence to suggest this, but in the same period of time where people are more likely to become traders based on their environments, based on people telling them to become traders, we're also seeing traders become less successful because they have less mental resilience that actually is required to be a trader in the first place, right? I think that social media algorithms are very dangerous. And I think that, as a trader, you need to have a strong mindset. You need to have a long attention span. You need to be able to stare at charts for hours on end to find trends, to analyze trends. And you can't rush into the first thing you find, right? That's why I brought up attention span. If you've got a low attention span, you're going to get bored very quickly, and you're going to see a trade, it's going to look fine, and you might take it when you could have found a better one 10 minutes later, right? So yeah, I think what do you think about that? Do you think that the modern generation and the attention span, decrease and all the things going on there have potentially made traders worse over time, even as the information gets better for them to actually educate themselves better?
I think you bring up an interesting point. I think the environment for traders in our modern day and age, in comparison to what it was like, 20 years ago, I think a lot has changed. I really think a lot has changed when you look at access to financial markets, when you look at how much money is circulating, when you look at monopolies on different companies manipulating markets. I think there's a lot more to it, right? I think it's a hard comparison to make. I do think that social media has definitely, from a societal standpoint, if we're looking from, can you become successful as a trader from a social standpoint, I think there's definitely been a push towards attaining financial wealth in other sectors rather than just the 9 to 5. I believe that's pushed more people into trading. I do believe the attention span thing is definitely very relevant because, to become a successful trader, one of the key hurdles you need to come over is experience, particularly chart time. You need to spend a lot of time staring, watching, looking, analyzing, learning, comprehending charts. You have to, okay? When you get past that point and you're an experienced trader, you can significantly reduce the amount of time you're looking at charts because you know when to look. You also know exactly what you're looking for, so you can directly look for those things. But when you're new, one of the big learning curves is you don't know anything. You also don't know what you don't know. You don't know anything and you don't know what you don't know. So the only way to find out is to either find someone or find a group of people or a coach or a mentor who is proven and trusted and has your best interest in mind. And again, with a lot of the rise of social media, there's a lot of fake gurus out there trying to sell you scams. And if you're not vetting where you put your money, who you trust, that could be a detrimental trap for you in the first place, right? So say, for example, you find a group of people who you do trust, who they have your best interest in mind, and you're learning through them, then that can definitely speed up the process in which you do become a better trader. But I think we're digressing a little bit. The question is more or less, can anyone succeed as a trader? I'm going to kind of bring it back to the upbringing. So what I said to start off with was people have genetic or social different social upbringings, different genetics, different personality traits, and all these definitely do impact you as a trader. Some people are more impulsive. Some people have more mental resilience, right? Some people are more risk-taking. Like there's certain personality traits that definitely either you develop in a child by your childhood, or they are just inherently instilled in your personality, which affect your ability to become a trader. And I think this is where the bridge kind of crosses between whether you're going to succeed or whether you're going to fail. This is kind of where it crosses. Every single person has some degree of shortcoming, whether it be from your upbringing or from your personality, that will damage your profits as a trader. No one is like the perfect specimen to become the perfect trader. Everyone has some challenge, whether it be emotional challenge or a behavioral challenge that is going to limit their trading. So your role as a trader, your role as someone who wants to trade, your role as someone who wants to become a successful trader is to find out exactly what your barriers are. Find out exactly what you're struggling with, whether it be impulse control, whether it be revenge trading, whether it be you're fat fingering every trade, you're putting too much risk. Find out exactly what it is that is making you fail. And again, these concepts that are making you fail could be from your upbringing. For example, impulse control example I gave you. If you have impulse control issues that have been developed from your childhood, they're going to be a lot harder to fix. And this goes into another thing. You don't have to fix all of your barriers when trading. You don't have to master impulse control. If you can master it and if you can fix it, that's great. But a lot of people can't. So then the next step is, what can I apply? What rules can I apply when trading to limit the effect of this poor impulse control? I need to create a set of mechanical rules. For example, I only trade 2 trades a day. I only trade until I and if I lose $100, I stop trading. What like actual rules that you have on your wall, like you have on your desk, you have on your wall, you have on your phone, you can see them that you will follow. And these things are designed to avoid you from revenge trading, or they're designed to avoid you from being impulsive, because sometimes you can't fix these barriers, right? Sometimes they are too strong in your personality. Like I was talking to a member the other day, and he said risk taking was one of his things. Like he couldn't get over risk taking. You know, he couldn't get over impulse buying, like FOMOing in. He would go a week or two without doing it, and then it just happened. You know, he'd go a month or two without doing it, and then it just happened. And like what we said to him was, you need to create a set of rules and strategies that you can implement on every single trade to positively reinforce those strategies so it doesn't occur. Because if you don't have a strategy or a set of rules in place to prevent that occurring, it can just pop up. And all it takes is one really, really bad trade to ruin like a month of profits, 2 months of profits. We've all been there, guys. We've all been there where we've been in a trade, it's going south, and instead of exiting that trade, we're like, no, we'll leave it a little bit longer. We'll leave it a little longer. We'll leave it a little bit longer. And then you're down like 5 times as much as you should have been if you just took the trade out. So that's kind of what I think. I think everyone can become successful as a trader. I think some people are, again, their starting points are different. Some people are way worse off to start off with. They've got a lot more to do from an emotional standpoint. And then some people are just a little bit better. They've got more mental resilience. They've got more mental toughness. They've got less impulse control. They're less risky. They're more methodical, like you said. But that it bridges into more things. Like I said, it bridges into, actual behaviors. So you can kick it off. What do you think? Like from a behavioral standpoint, from an educational standpoint, do you think anyone can succeed?
Look, I wrote down while you were speaking there, I wrote down something that I've just thought of, and I said, your personality dictates your actions, but your actions also dictate your personality in the long run, right? So you are obviously, your choices are obviously dictated by your personality to an extent, but you need to have that mental resilience to also change your personality, because your personality can change. You don't just have a personality and you're stuck with it. As you go through experience in life, your personality changes. You as a person, you change. So what you can do with trading, bring it back to trading, as you said, if you've got poor impulse control, and this is something I also wrote down, trade with a fixed amount. Yes, you're not going to be in the ideal position because obviously every trade is different. Every trade requires a different amount of capital, a different stop loss, etc. But guess what? Trade with a fixed amount. If you rarely struggle with impulse control and you can't stop yourself, have only a certain amount in your Binance account, in your BitGet account, and only trade with that amount, whether it be 1,000, whether it be 10,000, that's your fixed amount. That's what you use for trading. You don't trade with any more. You don't change your position size during trades. Yes, you're going to be in a worse position objectively, but if you can still do TA correctly, you should have like a 70 to 70% chance of profitability rate there. So that's one thing you can do. Like you said, you can do things and you can build these habits like trading with fixed amounts, like never exceeding a 10% stop loss, or only finding trades that have a maximum of 10% stop loss. You can do these things and you can build these as habits so that your impulses cannot get the better of you. Because, 90, as you said, I don't know the exact data. You probably know how many people lose money in a financial market. It's like, what, 90%?
It's like 96 to 98% of people. It's really high. Like it's and it becomes higher and higher as you look at we go from swing trading to scalp trading. Like scalp trading is the highest amount of losers. So like it becomes like the more like smaller of a time frame, like the more you're going to be losing essentially,
Yeah,
so it's really high. It's really high.
You could say, and this is what a lot of people would say, you could say, oh, scalp traders lose the most because they're gambling, because they're gamblers. They just want short-term reward, short-term dopamine. And for a lot of them, you're probably correct, right? But that doesn't mean scalp trading as a whole is a bad thing. It just means that no one's doing it correctly, right? So
scalp traders make a lot of money too, right?
Exactly.
Like you can make a lot of money scalp trading. Like I personally make a lot of money scalp trading. That's what I mainly do, scalp trading.
Correct.
It's like, again, with anything with more risk, there's going to be more reward.
So, you need to differentiate yourself from the rest of the market, because at the end of the day, this market's player versus player, just like everything in life. We are essentially competing with you. I'm competing with you, Whale. If we're buying the same coin, if we're trading, we're counter trading, we're competing against each other. It's a battle, basically. So how are you going to make yourself better than the opponent? I can tell you right now, if you have poor impulse control, you're in a very bad position to start with. You need to take action. You need to change those habits, and you need to form new habits. It's not going to be easy, but the alternative is losing money. So what's your choice? That's what I'd say about it. So
and it comes back to that. Like, well, before we go on to our next topic, I'll add one more thing. Before learning TA, before analyzing charts, you can drastically increase your profitability as a trader just by checking your emotions, just by getting your emotions in check and creating a set of personalized rules that go to counter your weaknesses. Just that alone will increase your profitability greater than 95% of market participants, because the majority of market participants have no clue what they're doing. They jump in, they jump out, they win a trade, they feel good, they get confident, they take another trade, they win it, they get overconfident, they take a big trade, they get wrecked. And it's like a back and forth cycle. I like to call them successful, consistent losers. They're winning, they're losing, they're winning, they're losing, not really getting anywhere. They'll blow up an account, they'll put more money in, they'll make a lot of money. It's just back and forth. They're not really consistently profitable. They're just consistently blowing up their account over a period of time. So just by implementing strategies, rules that target your emotions, particularly your behavioral downfalls, will make you significantly more profitable. But let's go into the other topic now. What stops 90% of people from actually succeeding? Because we kind of talked about, can anyone become a trader? We've talked a little about like rules and applications you can apply to yourself when you're learning to trade beyond just TA from emotional standpoint to fix those downfalls. But what actually stops 90% of people from trading? We've talked about emotions. Let's talk about like practice. Like this is kind of something I've been talking about a little bit more lately. And it comes back to TA, right? To become a successful trader, two things have to occur. One, you have to get a grip of your emotions and you need to fix your emotional shortcomings. So like I said before, your behavioral shortcomings, the things that are detrimental to your profits, you need to fix. You need to apply rules, you need to apply strategies. And number two, you absolutely need to find a way to create an edge in the market, all right? You need to. You will not profit without an edge. What is an edge? An edge is a statistical probability, well, I don't know what the word is, a probability that you have a statistical advantage over everyone else in the market over X amount of trades. So say you take 100 trades, okay? The probability that you win is like 61%. That is the edge, okay? So it's a statistical probability or a statistical advantage over numerous amount of trades. Now you can create that edge through a variety of different things. You can create it through a specific mechanical trading strategy. You can create it through different forms of technical analysis. You can create edges with algorithms and bots for news tradings. Like there's so many different ways you can create an edge in the market. But again, it's a statistical advantage. So when it comes down to trading, knowing that the only way to become profitable is having a statistical advantage over a group of trades, you have to alter the way you look at trading. Okay, so a lot of people look at trading like this. They look at a trade, win or lose. They look at another trade, win or lose. They look at another trade, win or lose. Look at another trade, win or lose. And they base how they're feeling, what they think based on the result of each individual trade. That's not how you look at it. You need to create a strategy, have a set of rules that you follow to the absolute T for a group of trades, 100 trades, 200 trades, 300, 4 months, 5 months, 6 months, whatever it is. Then you'll see the true profitability of that strategy and the potential edge that strategy has, okay? Yep. So a real trader will look at not the individual trade, but the collective sum of trades and base their success off that. An amateur trader is going to look at each individual trade itself and base their success off that individual trade, when in reality, it is impossible to even think about winning every trade you take. It is not knowable and it's unknown. The result of any individual trade is not knowable and completely unknown. You do not know where it's going to go. All you can do is apply the strategies or apply the technical analysis or structural analysis that you have in your strategy, your overall strategy, which you know has a 10% edge, whatever it is, into each individual trade and allow that to take course. That's it. That's my point. My point is the main thing that stops people from becoming successful as a trader, besides emotions, is a lack of a plan or strategy. They don't have a plan or a strategy. Essentially, without a plan or strategy, you are gambling. You are completely gambling.
Treat it like a job.
Further. I'll go one more thing. I'll go further. Yep. A lot of people don't even know when their plan or strategy is effective. And number two, a lot of people don't even know how to create a plan or strategy. How can you create an edge in a market if you don't understand how the market works? If you don't understand how a market moves, if you don't understand how price data works, if you don't understand how volume ranges works. So to understand, you need to know TA. You absolutely have to know a degree of TA to even facilitate an environment of knowledge where you can create a strategy that provides an edge. So like I said, you don't know what you don't know, right?
Correct.
Anyway,
exactly.
Leave it to you.
I suppose to summarize that, you could just summarize by saying treat it like a job. Trading's not a hobby. It's not something you can't have a hobby in which everyone loses 90% of their money. 90% of people lose money. That's not a hobby. That's it. That's the only way to succeed in that market is treating it like a job, like a profession. It's not something you do for fun on the side. I don't like people who say, oh, I trade on the side. It's like, no, you don't trade on the side. That's not something you can do on the side. It's a full-time job. You need to create strategies. You need to have spreadsheets going out. You need to have, what is my percentage? What is this? What is my return? What is my stock? That's not a hobby. That's a job. So, I suppose people could say, well, I don't have time. It's like, well, make time, because if you're trading right now and you're losing money, so you have time to lose money. Why don't you have time to make money? Make time. So you have to treat it like a job. That's very important in my opinion. I think that kind of summarizes the overall kind of arching mentality behind it. Yeah.
Yeah. So I'll kind of push this question to the audience right now. How many people here, let us know in the comments, how many people here do these two things? Track their trades and have an actual trading strategy. How many people actually have a set of entry conditions, close conditions, stop loss placement conditions, target conditions, and capital management conditions that they actually follow each trade? How many people actually have that? Because if you don't have that, you can't become successful. You're relying on luck. You're genuinely relying on your luck. You're hoping that you'll make a good trade, and you're hoping you'll make another good trade, and you're hoping you're making another good trade. But if you don't actually know your conditions and your limitations of what you're doing, you can't properly calculate the probability of your success. And if you don't know the probability of your success, how can you sit there and say, I'm going to be a profitable, successful trader in 5 years' time? You can't. It's a complete roll of dice. Wolf, can I get you to click this? Can you allow me to screen share? I just want to show an example.
Sure thing. There we go.
This is a strategy I've been forward testing, and I highly recommend do not back test. Do not back test anything. Only forward test strategies. Back testing for technical indicators don't work.
Yep.
I'm going to go ahead and screen share something really quickly with you guys. I hope, can you see this, Wolf? Let me know, can you see this?
Yeah, it's on the screen. Yep, sure.
So this is a strategy I've been forward testing. So I've been talking about in VIP. There's specific entries and close conditions. It's a mechanical strategy, meaning I take the trade. I don't care what the market's looking like. I don't care about anything besides these entry conditions, okay? We're taking 75 trades. We've had 48 wins. We've had 27 losses, a win rate of 64%, starting capital of 10,000 minus fees, total portfolio profit of 217%. As you can see, completely methodical trading. The clear entries, clear closes, clear stop loss placements, targets are completely randomized. Again, they're completely mechanical. We're trying to eliminate decision making while keeping it to a degree of logic and based on TA. Okay. If you look at the trades over here, every single trade is tracked, date, time, price, capital amount, profit and loss. But overall, guys, even with a strategy that doesn't really require much active engagement, that's purely mechanical, you can see that you can actually turn profit. So it tells me two things. Number one, the market is completely random and it's just a roll of the dice. Or number two, that following specific entry conditions such as this can give you a statistical edge over a number of trades. And again, 75 trades is not nearly enough to fully assess the profitability of a strategy. It's not enough. We have to do a lot more, but this has been going since the 14th of September, but it's an example of something that you guys are going to do. If you haven't been developing a strategy or tracking your trades or doing something like this, you'll never really know if you've got an edge in the market. If you don't know that you've got an edge in the market, you don't know that what you are doing works. And if you don't know what you're doing works, it means you're rolling the dice every trade and you're hoping for the best. You can't expect to become successful if you don't know, again, not only the shortcomings of your strategy, but where they shine. I'll give you an example. If you're taking a trade, if you're trading and you lose 3 or 4 trades in a row, if you don't know the probability that you will lose 3 or 4 trades in a row in a strategy, you are so likely to say, okay, this strategy sucks. I'm jumping out of it. I'm going to go something else. Okay. With 100, 2,000, 3,000 trades tracked, you can specifically say, I know there's a 5% probability that I will lose 4 trades in a row. So when you lose those 4 trades in a row, you're not sitting there panicking and say, oh, I lost 4 trades in a row. I suck at trading. Everything's going horrible. I suck. No, you'll stick to your strategy because you know that at the end of the day, you have a statistical probability that if you just keep going with it, you'll come out at a profit as shown with this example. I'm going to leave it there. Wolf, you got any closing thoughts?
I don't really have any closing thoughts. What I will say, though, is this. Yes, you might counteract these points. Someone might say, well, every trade's different. How am I expected to enter every trade the same way? It's like, you're not expected to enter every trade. You're meant to pick the trades, and you're meant to trade coins based on the certain set of strategies. Now, you can have multiple strategies. You might have multiple of these spreadsheets for a different strategy, and they might all be profitable. In that case, you can pick and choose, and you can enter trades different ways. But if you've only got one strategy, cool, only enter trades that apply to it. That's what I'd say. You have to pick and choose.
Yeah, and this is just an example of one I'm testing. Like,
Correct.
This isn't what I currently use right now. I don't use this. This is one that I'm testing for a specific purpose. Like, I've got a specific purpose of a strategy that I want to achieve. So I've outlined the mission statement of this strategy. I've defined my rules, and I'm testing it for a purpose to see if it's successful over like a year time.
Yep.
If it's not successful at the end, I'll just scrap it. I've wasted a year of my time. But if it is successful, I'll apply it to my trading.
Yep. Correct. All right. So we're running out of time. Have to end the video there. If you want to learn how to trade like usual, this is the Crypto Academy channel. We've got the Crypto Academy course. We have trading diaries in there, by the way, which is relevant to the last topic we've talked about. We have that kind of thing in there that shows you how to do that, how to track your trades, and gets you in that habit. So that's one of the things as well. But we've also got PowerPoints, we've got videos, we've got worksheets, we've got many, many things there, as you can see via the unit topics, and how many slides, how many videos and worksheets we've got. You can find that all on the website in the pinned comment or description below. 83 students, payment information's there. Send us an email, completely free. We'll send you back a video explaining the course, and then you can make an educated decision. No obligation there, just chuck us an email for free and we'll send you back all that info. All right. So thank you for watching. Hope you enjoyed, and I'll catch you in the next one. Cheers.